While your top 5 requests load in, we'll take a high-level view, scanning through the headlines and checking futures across key indices. Futures first, then your list. Pick 5 tickers or currency pairs, and I'll guide you through the technical setups and the underlying business story. The Goods Trade Balance Report measures the difference between a country's exports and imports of goods. A negative balance indicates that imports exceed exports, which can be a sign of robust domestic demand or declining competitiveness in global markets. This report can provide insights into the health of the manufacturing sector and its influence on GDP growth. A larger deficit than expected may signal economic weakness, while a smaller deficit could imply improvements in trade performance, impacting currency and stock market expectations. If the reading is less than what the market anticipated, dollar index will rise as a smaller trade deficit may indicate a stronger U.S. economy, boosting USD sentiment. S&P 500 ETF may increase due to improved outlook on trade balance, bolstering investor confidence in equities. International Developed Markets ETF may fall as a stronger dollar reduces competitiveness of U.S. exports. Long-term Treasury bonds may rise as a positive trade balance supports demand for safe haven assets. Consumer Discretionary ETF could rise as a stronger trade position suggests healthy consumer spending. In case the results indicate unexpected strength, dollar index will fall as a larger trade deficit indicates potential economic weakness, dampening USD strength. S&P 500 ETF may decline due to concerns over trade imbalances affecting corporate profitability. Emerging Markets ETF may rise as a larger trade deficit could spur capital flows to emerging markets. High-yield corporate bonds may fall due to fears that a worsening trade balance could signal economic vulnerability. Materials sector ETF may drop, as a significant trade deficit raises concerns over demand for raw materials. The S&P/Case-Shiller Home Price Index, HPI, Composite 20 measures the changes in the price of residential properties across 20 metropolitan areas in the United States. It is a critical indicator of the health of the housing market, reflecting supply and demand dynamics and broader economic conditions. A higher reading indicates stronger home price appreciation, which can point to consumer confidence and economic stability, while a lower reading may signify a potential cooling in the housing sector, impacting consumer spending and investment. This report is closely monitored for signals on inflation and economic strength, especially when the actual figures deviate from forecasts. If the release misses the forecast, the SPDR S&P Homebuilders ETF may decline as a weaker home price index indicates cooling demand, impacting builders' profitability. Lennar Corporation may see a drop as declining home prices could hurt buyer demand, affecting future sales. PulteGroup is likely to be negatively impacted as lower home price appreciation signals sluggish market conditions. Zillow Group may fall as weakened home price growth could lead to reduced transaction volumes in real estate. The Financial Select Sector SPDR Fund could dip, as a weaker housing market can increase default risks, affecting banks' lending outlook. If the published data impresses the market, the SPDR S&P Homebuilders ETF may rise as stronger home price growth fosters confidence in the housing market and builder performance. Lennar Corporation is expected to benefit as higher home prices indicate strong demand, potentially boosting sales and margins. PulteGroup could experience gains as robust home price appreciation supports builder sentiment and buyer engagement. The S&P 500 ETF may rally as positive housing data signals consumer confidence, contributing to broader market optimism. The Financial Select Sector SPDR Fund may rise, with stronger home prices reducing risks for mortgage-backed securities and improving bank outlooks. The Consumer Confidence Index, CCI, reflects consumers' perceptions of the current and future economic situation, which greatly influences spending and investment decisions. An increase in consumer confidence is typically a sign of economic strength, suggesting that households are more willing to spend, potentially leading to higher GDP growth. Conversely, a decrease can indicate economic weakness. This report is essential for gauging the overall economic sentiment and may have significant effects on market volatility, particularly if the actual figure deviates substantially from the forecasted value. Should the data come in shy of estimates? Consumer Discretionary ETF XLY may see selling pressure as lower consumer confidence suggests reduced spending potential. The S&P 500 ETF could decline as reduced consumer sentiment raises concerns about future earnings growth. The Dow Jones Industrial Average may drop as consumer confidence impacts economic growth expectations negatively. Target Corporation could experience declines as retailers may face lower consumer spending. High-yield bond ETF HYG might fall as weaker consumer sentiment could raise concerns around corporate earnings. If the report comes in well above market forecasts, Consumer Discretionary ETF XLY is likely to rise as increased confidence suggests stronger consumer spending. The S&P 500 ETF could gain as higher consumer confidence supports optimistic growth outlooks. The Dow Jones Industrial Average may rally as positive consumer sentiment boosts economic growth expectations. Amazon could benefit from increased consumer confidence leading to higher online spending. Investment-grade bond ETF LQD may see upward movement as strong consumer sentiment reduces default risk concerns. The JOLTS, Job Openings and Labor Turnover Survey, Job Openings Report provides valuable insights into labor demand in the economy at the end of the reported month. This report is closely monitored by policymakers as a key indicator of economic health and potential wage pressures. A higher job openings number typically indicates strong labor demand, suggesting a robust economy and possibly supporting hawkish monetary policy from the Federal Reserve. Conversely, a lower number could reflect weakening demand for workers, potentially leading to expectations of a more accommodative monetary stance. The report can significantly impact market volatility, especially when actual figures miss or exceed forecasts significantly. Should the data come in shy of estimates? The dollar index is likely to decline as weaker labor demand lessens the prospects for Fed tightening in monetary policy. Eurist may rise due to a weaker dollar amid disappointing labor market data, enhancing euro appeal. Long-term Treasury bond prices are expected to increase as yields fall in response to a weaker labor market outlook. Gold prices could rise as the dollar loses strength, driving investors towards safe haven assets. The ARK Innovation ETF may see gains as a softer labor market could signal less aggressive Fed policies, benefiting growth stocks. If the outcome is more favorable than forecasted, the dollar index is likely to appreciate as stronger labor demand reinforces expectations for continued Fed hawkishness. Eurist may decline as a stronger dollar arises from positive labor data, suggesting economic strength. Short-term Treasury yields are expected to rise, leading to a decline in SHI ETF as investors anticipate tighter monetary policy. Gold is likely to fall as favorable labor data strengthens the dollar and reduces demand for non-yielding assets. The S&P 500 ETF may drop due to fears of persistently high inflation and the potential for tighter monetary policy following strong labor data. The Atlanta Fed GDP Now report provides a real-time estimate of GDP growth for the current quarter. This specific reading reflects expectations for Q2 and serves as a crucial indicator for economic momentum. With the previous estimate aligning with the forecast, market participants will pay close attention to this report to validate their outlook on economic strength and possible implications for monetary policy. A deviation from the forecast could lead to changes in investor sentiment, impacting market volatility. If the number is less favorable than projected, the S&P 500 ETF may decline as lower GDP expectations raise concerns about economic slowdown. The dollar index will likely decrease as disappointing GDP growth diminishes prospects for aggressive Fed tightening. Financial sector ETFs may drop as banks often suffer in a slowing economic environment due to potential lower earnings. Long-term Treasury bonds may rise as investors seek safety amid weakening economic projections. Industrial sector ETFs could see a drop as lower growth forecasts point to reduced manufacturing and business investment. If the data beats market estimates, the S&P 500 ETF may rise if GDP estimates exceed expectations, signaling economic strength and potential corporate earnings growth. The dollar index would likely increase on stronger GDP growth expectations, supporting a hawkish view for the Fed. Financial sector ETFs may benefit from improved economic outlook, which often leads to better banking forecasts. Long-term Treasury bonds could fall if GDP growth signals a need for tighter monetary policy, leading to higher yields. Industrial sector ETFs may gain from increased GDP growth forecasts, indicating heightened manufacturing activity and investment.